First, just a few high-level considerations. As some of you may know, San Francisco imposes a separate business registration requirement for persons that are engaged in business within the city. Within that definition, it includes a list of activities where if most taxpayers meet at least one of these business activities, then they would trigger a registration requirement. This slide shows a list of these activities. These aren't the entire list, but it shows you some common activities that would trigger a San Francisco registration requirement. Obviously, if you maintain a fixed place of business in the city, or if you have an employee, rep, or agent that maintains a fixed place of business within the city. So during this time of remote work, if you have remote employees who are working and living inside San Francisco, this would be considered a nexus creating activity. The last bullet point just shows that San Francisco not only has a physical presence standard, but also has an economic nexus standard. So for taxpayers that aren't physically present in the city, they can still trigger a San Francisco registration requirement if they have more than $500,000 of gross receipts that are sourced to San Francisco. And we'll talk about the sourcing rules and how it applies differently to each business activity type. So once you trigger a registration requirement, you usually have within 15 days to register. Otherwise, there'll be late penalties and interest that is imposed. The registration is valid for 1 fiscal year, so you have to renew the registration on an annual basis. There is a registration renewal fee that is charged, which is based on your prior year reported San Francisco gross receipts, or when you file the initial registration, it will ask you for your estimated San Francisco gross receipts. And so for this year, the fiscal year 2021-2022, that registration renewal fee was extended until November 1st, 2021. So if you filed a 2020 San Francisco business tax return, the city will likely have your San Francisco gross receipts on record and will send you an invoice, or a payment will appear in your payment portal that shows you what your registration renewal fee is for this year. So let's talk about some recent legislative highlights. These were passed back in last November during the election. Proposition F significantly changed many aspects of the San Francisco business tax area. First, it reduced the annual registration fee for businesses making less than 1 million of San Francisco gross receipts. It increased the gross receipts tax return small business exemption threshold. So usually 2020 and prior, companies that had less than 1.2 million of San Francisco gross receipts were not required to file the gross receipts tax return. So that threshold increases to 2 million starting with the 2021 tax year filing. But Proposition F also increased the gross receipts tax rates for most industry types, with the exception of those industries who were hit hardest by the pandemic. It also eliminated the payroll expense tax. So as some of you may know, when you were filing your annual San Francisco tax returns, not only were you filing the gross receipts tax return, but you're also likely filing the payroll expense tax return and the commercial rents tax return. Going forward, the payroll expense tax return won't be applicable, but you'll still need to calculate your San Francisco payroll for apportioning gross receipts to the city if you're one of those business industries that use the San Francisco payroll factor to determine their San Francisco gross receipts. So you'll still have to go through that exercise, but there won't be a payroll expense tax on your company next year and going forward. It also added a new tax, which is called the executive pay tax. It's applicable to companies whose highest paid managerial employee is compensated more than 100-to-1 ratio to the compensation, to the median compensation paid to employees based in San Francisco. So this tax wasn't effective until January 1st, 2022. So we haven't gone through this process yet, but it's something to keep in mind that companies will likely have to either perform this calculation or have their tax firm perform this calculation to determine whether this additional gross receipts tax rate applies. So there's a increase in the gross receipts tax rate based on the ratio that exceeds 100 to 1. You'll see on this chart, there can be an additional 0.6% gross receipts tax rate if this ratio exceeds 600 to 1. But again, not effective until 2022. San Francisco also had some COVID-19 related relief responses. They waived the annual registration fee for certain businesses in the entertainment and restaurant industry. It's just something small, but usually we'll ask you this question on the 2020 return if you didn't file it or if you did. And if that question was marked yes, then they would likely waive your registration fee payment. Small amount, but it's something. So next we're going to get into the gross receipts tax in more detail, which obviously is still relevant, especially with the gross receipts tax rates increasing for most companies. We're going to talk about certain overlooked mitigation strategies to reduce your overall gross receipts tax exposure. But first, just want to talk about some general concepts. The gross receipts tax ordinance actually imposes different gross receipts tax rates based on a taxpayer's primary business activity. So San Francisco uses a progressive tax rate table, but those tables are different based on the primary business activities that are chosen on the tax return. And companies may not just have one primary business activity that applies to them. There are rules for taxpayers that are engaged in multiple business activities, which we'll talk about in the tax mitigations slides. But generally, a company would determine which industry code they're in for San Francisco tax purposes by looking and determining which code under the NAICS system is most applicable to them. And usually that code is reported on the federal return. But the importance here is that a company isn't tied into the NAICS code that's reported on their federal return as the one that they need to choose for San Francisco tax purposes. San Francisco is really referencing that manual to determine which 6-digit code applies to the company. And again, whatever that code is or codes, if you're engaged in multiple business activities, that will determine how you source gross receipts to the city and also determine which gross receipts tax rates apply to your company. And we'll talk more about that in the next few slides. There's 3 main types of apportionment formulas that again are based on these business activities that company decides. One of the methods is called the apportionment method, which is based on the calculated San Francisco payroll factor of the company. And we'll talk about how that's calculated in a little bit. There's also the method that is called the allocation method, which uses a market-based approach. So instead of looking at the amount of payroll expense that's sourced to San Francisco and applying that percentage to worldwide gross receipts, taxpayers that use the allocation method will look at how those gross receipts are sourced under a market-based approach. And the third method combines the first 2 methods. It's known as a combination method. And again, these aren't options for a company to select. They're required based on your industry code that you choose. And we'll talk about which methods apply to which industry types. Under the allocation methodology, again, you're looking at the types of gross receipts that you earn. So if you earn receipts from the sale, lease, rental, or licensing of real property, those receipts would be sourced to San Francisco if that real property is located in the city. If you sell tangible property, then it's the amount of sales that are delivered to a purchaser in the city. If you perform services, then it's the amount of gross receipts that are from those services where the benefit of the service is received by a customer inside San Francisco. And if you receive gross receipts from intangible property, it's those receipts from property that is used in the city that would be considered San Francisco source if you're required to use the allocation methodology. Those rules are different if you have to use the apportionment methodology, which using a high-level approach takes your worldwide gross receipts and multiplies it by your San Francisco payroll factor. The payroll factor is a fraction, the numerator being payroll that is sourced to the city, and the denominator being your worldwide combined payroll. And we'll talk about how each of those factors is computed. This slide shows you the sourcing methodology that is assigned to different business classifications. So if you go through the process of looking at which NAICS code or codes applies to your company, then if that code is in the, for instance, retail and leasing services sector, then you'd use the allocation method. You'll see that financial service companies, those engaged in professional and technical services, use the apportionment method. So they're determining what their San Francisco payroll factor is. And those that are in the information sector, which a lot of the software companies in San Francisco have classified themselves under, they use a combination of both the apportionment method and the allocation method. So the key takeaway here is that it is confusing. San Francisco has different tax rates based on your primary business activities, and they also have different rules on how to source your gross receipts to the city based on the business classification that you decide is most relevant to your company. And we talked about that these tax rates are increasing starting in the 2021 tax year for most industries. This slide shows you what those rates were prior to 2021. So you'll see that on the second row, it includes business classifications such as information, biotech, food services, manufacturing, etc. And I had mentioned that a lot of the software companies chose the information classification because, as you'll see, it has one of the lowest gross receipts tax rates. San Francisco caught on to that as part of Proposition F, and as you'll see in the next slide, are significantly increasing those tax rates. Financial service companies also have had one of the highest gross receipts tax rates compared to other classifications, and their rates will still remain high and will increase a little bit going forward each year. The next slide, like I said, shows you what the new rates are compared to the old rates. I highlighted some of the sectors that saw the biggest rate increase. So again, information filers, their tax rate table in 2020 ranged from 0.125 to 0.475, and starting in 2021, the tax rate table is between 0.56 and 0.784. So pretty significant increase for those that classify themselves in financial services, insurance, or professional, scientific, and technical services. Historically, they were between 0.4 and 0.56% as a gross receipts tax rate. That will increase next year to a rate between 0.56 and 0.784. So you'll see that a lot of these industries will see increasing gross receipts tax rates. And that's why it's important to understand both the sourcing rules and how to determine your San Francisco payroll based